Hello everyone. On this FOMC day, we're here to break things down and bring clarity in what was an incredibly volatile day. One of the most volatile days I can certainly remember. We hit the lows of the day after we got the decision. Then we hit the highs of the day after we got the press conference and the Q&A. And then we hit the lows of the day once the correction occurred. So what are we making of all this? What are we making of the decision? What are we doing and what have we done? What are we making of all this? Well, the trend is hawkish. Every single time Powell has spoken, he's gotten progressively more and more hawkish. I get it. He said the message is the same as Jackson Hole. So one can argue that he didn't get much more hawkish. He was just continuing Jackson Hole. The market clearly didn't see that in the meeting. I mean, it was clear as day. The Jackson Hole meeting gave us a tremendous pullback. He said, I'm trying to continue that. It should have given us a tremendous pullback, but instead the market decided to go to highs of the day, whatever. Here's why, 20% on the phone. Here's why I think this was even more hawkish than Jackson Hole. 100 or 125 basis points left in the meeting. That there's a substantial group of people at 125 basis points left in the meeting. When we were at Jackson Hole, we were thinking, okay, we're pretty much on autopilot to 4%, and that's going to kind of get factored in, and we're trying to, get the market to price out some stuff in 2023, some rate cuts it had in 2023, which it actually had until this morning. I don't know where it's settling at right now, but that is clearly getting pushed out until at least 2024. So there was a more fact-based hawkishness today. There was the rest of the year is actually going to probably end up being above 4% by the end of the year. I believe I saw 4.4%. So it's a hawkish environment right now. That's just the way it is. And we're gonna deal with what we get. So as the meeting went on and occurred, people seem to grab onto things like data dependent, and they think that is, dovish because the data might come in better than expected. Well, the people who thought that in July clearly got burned in the past couple weeks. Once we got the August data, that was worse and was substantially worse. Not only was inflation hotter than expected, not only did inflation go up after being flat month on month, but it was in the most important areas of the economy, which are food and rent inflation, continuing to hit multi-decade, if not all-time highs in the case of food. So the environment for a hawkish Fed remains and continues to increase. Will it continue to increase? I'm not sure. There's a lot of questions around that. However, that doesn't mean that we can't make moves and that we haven't made moves and that there aren't still moves to make. For example, Apple, other mega cap tech companies are trading at well above historical multiples. I'm not talking about the market cap. I get it. These companies grow. They are earning more than they used to. But their price relative to their earnings is higher than it is historically. And historically, and in the last 10 years, we've been in a quantitative easing environment with low interest rates and an accommodative Fed. It's quite clear the opposite is occurring now. And the thing with interest rates is when they go up, there's less reason to buy stocks to grow your money. When you can loan money to the US government, who has the capability of printing that money and is essentially risk-free, paying you a quite substantial return. We're now over on the 2 years. So just if you're willing to part with your cash for 2 years, you're gonna make more than half of the expected S&P 500 return. Yet in the S&P 500, you get that volatility, you get that uncertainty. You may want that, you may not want that. It may impact your returns. Anyways, the average return for the S&P 500 throughout history is 7%. Right now, the 2 years averaging over 4%. By the end of this year, it will probably be closer to 4.5. And if the Fed holds true to their word, next year, it will be over 4.6 in theory. That's a good return. So what you're gonna see is people sell the stocks that are expensive, that are well above historical multiples, and they're gonna do the logical thing and adjust their risk. The risk-free return is going up. So you're gonna go and see where the high risker or riskier return is not so attractive. You're gonna take that cash and go to where the low risk is very attractive. And that's becoming more and more so the case. That's what the Fed wants ultimately. And that means that there is some more equity pullback to see because there's so many stocks that are quite expensive. I'm not trying to pick on these names. Let me clarify. I have an iPhone 14 pre-order coming soon. I'm shooting this on iPhone 12 Pro, iPhone 14 Pro rather. If I could afford a Tesla Model S Plaid, I would buy it. It's a great car. It's tremendously fast. I'm sure it's exciting. I've never been in one. I hope to soon and own one. But that doesn't mean I want to own Tesla here. As a matter of fact, I view it in direct line of fire of what's going on, and therefore I am short via stock and puts. And it pains me that I have to be shorting my man, my hero, my role model, Elon Musk's company. But my job is to make money for you, help you make money, and make money for my clients. And I just have to be agnostic beyond that. So I'm short Tesla. I think they are going to be victim of what's to come. All these stocks that were big companies prior to COVID that are like just have a chart that goes like this through COVID and are still on the 5-year chart quite high. A lot of those just have so much air under them to come down. And I think that's where the money that's going to flow into bonds as yields go up is going to go. I mean, obviously, I don't think all Tesla shareholders are going to go there to bonds. I think they're going to ride the wave, experience some pain, whatever, I don't know. But in theory, for Apple, for example, a lot of people have been viewing that as a flight to safety. There's been a TINA trade. There is no alternative. People went to mega cap tech as safe havens. Now that's going to get unwound. And where goes mega cap tech goes the market. Where goes the market goes many stocks. I'm not saying some stocks haven't bottomed, but a lot of them have big air pockets. And I mean big trillion-dollar air pockets. Collectively, multi-trillion dollar. I don't know if Apple's going to fall $1 trillion in market cap, but I wouldn't be surprised if it did. I just wouldn't be surprised if we saw a 20-30% move in Apple. I wouldn't be surprised. So I'm also short Apple, short Tesla, short the Qs in a leveraged way, TQQQ and long SQQQ. I'm not going to be in these positions forever, but Apple's a huge portion of the TQQQ and SQQQ, as is Tesla, as is Microsoft. Amazon might hold up a little bit better, I think, here, but still quite big. Google, very sensitive to advertising. We are seeing what they're doing to try and preserve themselves. More YouTube ads. It's kind of annoying. They're picking up, I believe, I felt like when I go into the YouTube app, I saw a higher price. I felt like that. I don't know what it was before, just anecdotal, but you can see the moves they're making are trying to keep earnings up. And that may not be the case. Earnings might have to come down. Therefore, PEs go up, therefore sellers come in because stocks get more expensive. So there's a wave coming, I believe. That's what I see. That's what I envision. I can't guarantee you it's not going to happen, but we'll see what happens. I don't know how far the market can get. I think 10 to 20% is not unreasonable. At some point in that range, I will start nibbling, but I'm not nibbling yet. I'm riding the wave down. I'm aggressively hedged to the downside. My longs are very light, and we'll see what happens. That's today's video, and until next time, peace out.